He beat the casino at blackjack. Then he beat Wall Street at its own game for 20 years, 0 losing years. Here is how. Princeton Newport Partners returned roughly 19% a year after fees for 2 decades. The S&P compounded at around 10% over the same window, every quarter, 230 consecutive months, not a single losing one. Ed Thorp did not predict markets. He did not read balance sheets. He did not pick winners. He ran a machine. The story does not start with stocks. It starts in the basement of UCLA in the winter of 1959. Ed Thorp was 27, a math postdoc. He had a problem he could not let go of. A casino roulette wheel spins a ball. Physics governs the ball. If physics governs the ball, the outcome is not random. It is merely hard to predict. Thorp reached out to Claude Shannon, the father of information theory, at MIT. Shannon had the IBM 650, one of the first computers on a university campus. Together, they built a computer the size of a cigarette pack, a concealed predictor, wearable timed by toe taps, broadcasting predictions into a radio earpiece. Las Vegas, 1961. The machine worked. Thorp won. The prototype also shocked him in the ear when the wiring shorted. A physics edge on roulette held for a summer before Vegas caught on. Then Thorp moved to a game where the math would hold longer. A game where physics did not matter but memory did. Blackjack, the only casino game where the house edge can be measured and in principle inverted. The math was obvious in retrospect. No one had published it. Thorp spent 18 months proving that basic strategy plus a card counting system could give a player a positive edge over the house. Small, around 1.5%, but positive, and positive repeated enough times compounds. In 1962, he published Beat the Dealer, the first mathematically proven winning strategy for a casino game open to the public. The book sold 700,000 copies. The casinos changed their rules. Shuffling machines arrived. Decks multiplied from 1 to 6. Counters got banned by name. The edge closed. This was the first lesson that would carry into Wall Street. Every edge has a disconfirmation event. For blackjack, the disconfirmation event was the shuffling machine. Thorp saw it coming, and he had already moved on. Then came the second game. By 1965, Thorp was on faculty at the University of California, Irvine. Young school, no distractions. He started reading finance journals. One instrument caught his attention. Companies sometimes sold what were called warrants. Think of a warrant as a voucher. The company sells it to you for a small price. It gives you the right to buy the company's stock at a fixed price years from now. If the stock rises above that price by then, the voucher has value. If not, it expires worthless. Nothing complicated. In the mid-60s, thousands of these vouchers were trading on exchanges. Nobody had a formula for what they were really worth. Thorp wrote one, not the famous option pricing model from 1973 that came 6 years later. Thorp's version was simpler, but the math was sound. His formula told him which vouchers were priced too cheap, which were priced too expensive. More important, it told him how to capture the gap without having to bet on the stock itself. You buy a cheap voucher. At the same time, you sell the company's stock short, which means you borrow shares, sell them now, and promise to buy them back later. One side pays off if the stock goes up. The other pays off if it goes down. They balance each other out. The stock could go anywhere. It did not matter. Only the price gap on the voucher closing mattered. Thorp co-wrote a book about it. Beat the Market with Sheen Kassouf in 1967, a trading manual nobody else was running yet. 2 years later, he and Jay Regan founded what would become Princeton Newport Partners. Thorp in California ran the math. Regan in New Jersey ran the brokers. Thorp had one rule for every position in the fund. The voucher and the short had to offset continuously, not approximately, recalculated as prices moved. They built custom software on an IBM machine to monitor the book in real time. 1969. Most professional investors were still using paper and calculators. The first quantitative hedge fund, before the word existed. Then the track record. From 1969 to 1988, Princeton Newport ran 230 consecutive months without a losing one. Average annual return around 19% after fees, roughly double the S&P in the same period. And here is the detail that defines the fund. Not a single calendar year with a loss over 2%. The 1987 crash, Black Monday, the market fell 22% in a single day. Princeton Newport finished October in the green. No heroic trade, no shorting the crash. The portfolio was balanced, so the crash passed through it. The edge was structural. A cheap voucher plus a short stock position does not care what the market does. It cares that the price gap closes. Thorpe was not calling the market. He had engineered a system where the market did not need to be called. In a Meb Faber interview much later, Thorpe summarized the philosophy in one sentence. Make sure the edge is real, then size for survival. Make sure the edge is real, then size for survival. The two halves of the machine. Now the second half of the machine. The sizing half came from Bell Labs. In 1956, a physicist named John Kelly published a paper on information theory. Buried in it was a formula, the Kelly criterion. Given an edge and a variance, Kelly told you the exact fraction of your money to bet on each trade to maximize long-run wealth, not profit in dollars, the rate at which your bankroll grows. Thorpe read the paper. He recognized it immediately. Was the blackjack sizing rule generalized? Bet too little of your edge, you leave growth on the table. Bet too much, you hit a drawdown that bankrupts you before the edge can compound. Kelly said the optimal fraction was exactly the ratio of expected gain to variance. No more, no less. But Thorpe noticed something else. The full Kelly fraction, the most mathematically optimal bet, was also the most volatile. It exposed you to temporary drawdowns of 50%, even when the edge was real. Most investors, Thorpe later wrote, cannot stomach a 50% drawdown. They pull capital at the bottom. The math works, the human does not. So Thorpe sized Princeton Newport at half the Kelly number, sometimes less. Half gives you roughly 75% of the long-run growth with a quarter of the drawdowns. Less greedy, more survivable. This is the size that let the fund run for 2 decades without a losing year. Then the raid, 1987. Federal agents raided the Princeton office of the fund. The prosecutor was a young attorney in New York named Rudy Giuliani. The investigation centered on a tax trade involving Princeton Newport and another broker, not on Thorpe's book in California. Thorpe was not indicted. No finding against him personally, but the partnership could not function under the investigation. Clients pulled capital. The fund wound down. In 1988, Princeton Newport Partners closed. After 230 consecutive months of positive returns, the legal trade that triggered the raid was eventually overturned on appeal. The record was quietly expunged, but the fund was gone. Thorpe continued running money privately in his own accounts at the same disciplined pace for the next 3 decades. No public performance, no press, on purpose. 20 years, 0 losing years, no market call, no visionary bet. Thorpe's record is not a story about genius. It is a story about a system with 2 halves that must both hold. First half, validate the edge before sizing it. Name the exact event that would prove the edge dead. Measure it across enough separate trades. Write down the offsetting trade that cancels market risk. Check that your costs don't eat the spread. Check that your winners still work when markets move together. Match your private notes to your public claims. 6 questions. Thorpe asked them on every trade. Second half, size below the full Kelly number, half or less. The math works on paper. The human behind the trade pulls the trigger. The tighter of the 2 constraints wins. The edge gave the returns. The sizing prevented the ruin. Both were required. Every blow-up in finance, long-term capital in 98, the pod shops in 15, Archegos in 21, failed on exactly one of those 2 halves. Edge imagined or size too big, usually both. Thorpe failed at neither, for 20 years, then 3 more decades in his own accounts. I put both halves of Thorpe's system on a single worksheet. 6 questions that force you to prove your edge is real before you risk $1 on it. A sizing calculator that gives you the exact fraction to bet, the same half that let Thorpe survive 20 years. A 15-point checklist for the risks that would wipe the position out. It is built for a position you have open right now. You fill it in on that position. If you cannot answer the 6 questions, the trade is not ready. If the sizing math gives you a number below what you have on, you are oversized. Link in the description. Free worksheet on edge, sizing, and survival. This channel takes one investor at a time, unpacks the system behind their record, turns it into a worksheet you can use on your own trades. Subscribe if that is what you came for. Next week, a different investor, the same breakdown.